Starting a business means juggling a lot, and not just what customers see. There's operating agreements, compliance filings, and legal paperwork that all make up your business identity. That's a lot to manage on your own. Start your business with Northwest Registered Agent. They help you get more for your business, more privacy, more guidance, and more resources. Northwest has been helping small business owners launch and grow their businesses for nearly 30 years. They're the largest registered agent and LLC service in the U.S., with over 1,500 corporate guides, real people who know your local laws and can help you every step of the way. With Northwest, privacy is automatic. They never sell your data, and they give you free tools like operating agreements, meeting minutes, and thousands of how-to guides. Don't wait. Protect your privacy, build your brand, and get your complete business identity in just 10 clicks and 10 minutes. Visit northwestregisteredagent.com/OFD-free and start building something amazing. Get more with Northwest Registered Agent at northwestregisteredagent.com/OFD-free. This is Optimal Finance Daily. Invest a lot of money at once or spread it out by Vicki Cook and Amy Blacklock of WomenWhoMoney.com. It's the week your big bonus from work hits your bank account, or you receive a sizable cash gift or inheritance from a relative. Perhaps you have proceeds from the sale of your home or cash from a rollover retirement account. Or you've just been saving money for a few years and now understand why it's essential to invest your money and not just accumulate it in a savings account. Whatever the reason, you now have a large sum of cash and you want it to start making more money. To capitalize on the power of compound growth, you're ready to invest it. But after doing some research and talking it over with financially savvy family and friends, you still aren't sure whether you should invest it all at once or spread it out over time. There's a reason for the mixed messages you're getting. There isn't one right answer. While research from Vanguard, one of the world's largest investment management companies, indicates lump sum investing is the method more likely to grow your wealth over time, your emotions matter too. Once you account for your possible reactions to significant market changes, it gets more complicated than following past trends and statistics. Whether to invest your money in a lump sum or use a dollar cost averaging strategy to spread investments over time is a frequent question. Let's take a look at the benefits of each approach to help you make a smart decision about how to invest your money. Lump sum investing. Lump sum investing isn't hard to understand. You put a large amount of money into investment vehicles such as stocks or bonds all at one time. You don't wait and see what happens to the price per share over time or invest in intervals. The benefit of plunging your money into the market all at once is taking advantage of the growth in the market sooner. Since the stock market has historically trended up over time, your money has longer to realize market gains. As stated already, research supports lump sum investing in a majority of situations when someone is questioning how to invest a large amount of money. Dollar cost averaging. Investing equal parts of a large sum of money at planned intervals, regardless of fluctuating price levels, is called dollar cost averaging. You may be familiar with this strategy if you invest in a retirement account regularly through your employer. With this method, you invest a set amount each pay period or each month, regardless of what the market's doing. And you won't normally cancel an investment just because the market is volatile. Using the dollar cost averaging approach helps newer investors or those with low risk tolerance adjust to and manage emotions around the roller coaster of ups and downs the stock market experiences routinely. How should you invest? After reading more about how to invest your money, it still comes down to what works for you. It's personal finance. While you can take advice from others and continue to do research, your tolerance for risk is key. Lump sum investing tends to work best for people who have higher risk tolerances, stable employment, and adequate liquidity. They can manage their emotions about money while focusing on long-term goals. Downturns in the market won't spook them into selling investments. Dollar cost averaging still may be the best option for some people, even though they miss out on exposing the full sum of money to the stock market sooner. By spreading out investments over time, the risk is also spread out. If your risk tolerance is low, a market decline after investing a lump sum of money may hurt your long-term investing success. If your emotions lead you to be fearful, sell shares at the wrong time, and change your long-term investing strategy, it can negatively impact wealth building. Another thing to consider is the size of the lump sum money and your age. Is the lump sum $5,000 or $50,000? It may make a big difference in your risk tolerance and overall strategy for investing that amount of money. Final thoughts on investing sums of money. To build a secure financial house, you want your money to start working for you as early as possible. But it's also important to take time and learn about different investing strategies like dollar cost averaging and lump sum investing. This way, you can determine what's right for you and avoid blindly following the advice of others or something you read online. Whether to plunge or wade into the market with a large sum of money is an emotionally charged issue for many. As an investor, you should always have clear objectives aligned with your financial goals and risk tolerance. Although it would be easier to invest a lump sum and it would likely be a good long-term decision, you might not be able to sleep at night if the market crashed a few weeks after you made a lump sum investment. If that were to happen, you might make choices to reduce your stress and anxiety that aren't good for your finances. What should you do if you don't have a large sum of money to invest? Don't wait to build one up. Start investing today. The sooner you invest, the faster you'll be making interest on interest. Keep reminding yourself of the saying, invest early and often. Good money habits help build long-term wealth too. You just listened to the post titled, Invest a Lot of Money at Once or Spread It Out by Vicki Cook and Amy Blacklock of womenwhomoney.com. The new year gets people thinking about finances, building an emergency fund, saving for a home, retirement. Done just tracking past spending? Want a tool that helps you actually achieve those goals? Set yourself up for financial success this year. Monarch is the all-in-one personal finance tool designed to make your life easier. It brings your entire financial life, budgeting, accounts and investments, net worth, and future planning, together in one dashboard on your phone or laptop. Be aware and in control of your finances this year and get 50% off your Monarch subscription with code OPTIMAL. I've been using Monarch for years. It keeps me focused on moving forward, not feeling bad about past spending. The savings projections help me make decisions that actually move the needle. Set yourself up for financial success in 2026 with Monarch, the all-in-one tool that makes proactive money management simple all year long. Use code OPTIMAL at monarch.com for half off your first year. That's 50% off your first year at monarch.com with code OPTIMAL.
This episode is brought to you by Indeed. Stop waiting around for the perfect candidate. Instead, use Indeed sponsored jobs to find the right people with the right skills fast. It's a simple way to make sure your listing is the first candidates see. According to Indeed data, sponsored jobs have 4 times more applicants than non-sponsored jobs. So go build your dream team today with Indeed. Get a $75 sponsored job credit at Indeed.com/podcast. Terms and conditions apply.
If you enjoyed this article, I highly recommend you go back and listen to episodes 1771 and 1772. In these 2 episodes, Chelsea Brennan from Smart Money Mamas makes a compelling case for why you should continue to invest even when the market is at its peak. But she also makes some comments on lump sum investing. You'll notice that the key variable is your time horizon. You won't lose money on lump sum investing regardless if you invest at a peak or dip, as long as your time horizon is 10 years or more. Chelsea says, quote, if I had $100 to invest a month, I would invest it every month instead of waiting until I had $1,200 at the end of the year. However, if someone handed me $1,200 today, I would invest it all now instead of bleeding it in over 12 months, even though traditional dollar cost averaging would recommend bleeding it in. And according to Vanguard, the majority of the time I would see better performance. Vanguard looked at rolling 10-year periods in the US stock market from 1926 to 2011 and back-tested the performance of lump sum investing versus dollar cost averaging. In other words, would you do better investing a certain sum of money today or bleeding it in over 12 months? What they found was that regardless of asset allocation, 65 to 67% of the time, you would see stronger returns putting the money in the market today than trying to smooth things out by leaking it in over time. The reason for this is that the long-term trajectory of the market is up. The more time your money is in the market, the better you do, end quote. And that'll do it for today. Have a happy rest of your day, and I'll see you on the Thursday show tomorrow, where your optimal life awaits.